The problem with art funds. This is Blackbird Rook, writing a weekly essay on contemporary art and the culture around it. You see it often. A glossy Instagram reel about alternative investments, a podcast telling you to diversify, a private bank suggesting art as a solution for clients bored of shares and property, or a certain kind of gallery where the conversation is less about paintings than investment. Wherever you meet it, the language is familiar. Art holds its value. It does well when inflation rises. It moves differently from the stock market. So you put some money into an art fund, let other people choose what to buy, and hope it goes up. It sounds appealing. The trouble is that art doesn't behave well, and art funds usually fail because the structure is wrong for what art is. The first problem is that it's expensive for the funds just to own the work. They charge fees for running the fund, and then there are the costs of keeping art: storage, insurance, shipping, photography, condition checks, legal paperwork. None of this is optional. By the time you add it up, the art has to rise a lot in value just to break even. The fund manager's incentives can also cause problems. If a fund earns money simply by existing, the pressure isn't always to make good decisions, it's to keep the fund going. That way the fund manager is making money, even if you aren't. The second problem is that selling art is hard. When people say an investment is liquid, they mean you can sell it quickly for something close to the quoted price. Shares are liquid. Most art is not. Selling a work of art can take months or years. It depends on timing, who you know, whether the artist is in fashion, whether the right buyer is looking at the right moment. You also pay costs when you sell: a dealer commission or auction fees, shipping, insurance, maybe restoration. You can't press a button and get out. This really matters, because most funds have a timetable: 5 years, 10 years, a date when investors expect their money back. That works with things that trade all the time, but it's a problem with art, because the best sale often happens when you can afford to wait. If you are forced to sell because the funds is ending, you'll usually sell at the wrong moment. The third problem is that buying well needs real judgment, not just confidence. In shares, you can look at profits, debt, competitors, and other hard facts. In art, especially with newer artists, you need a deep understanding of quality, context, and whether the work will still matter in 10 years. That kind of judgment is rare. It takes a deep level of knowledge. Funds often end up paying for the things that look safe. There is a good buzz, a good story, famous names in the room, access, but those signals can disappear fast. Most artists who are lucky enough to have a moment in the sun find themselves in shadow a few years later. And then there's the bigger issue people don't like talking about. The art market is hard to measure honestly. Most of the data in art comes from auctions, because auction results are public. But auctions are not the whole market. They're the visible tip. A lot of important work never appears at auction because it goes into museums or long-term private collections. Some prices are pushed up by buyers who are not buying like investors at all. They're building a legacy, supporting an artist, or thinking about donations and reputation. Dealers also hold stock back to protect an artist's prices. Again, this isn't a conspiracy. It's just how the art world works. There's another hidden reality too. Many collectors would get less than they paid if they sold everything at once. Once you include all the costs, commission, shipping, framing, insurance, plenty of people are sitting on losses. They don't rush to sell, because nobody enjoys making a loss public, so the works that are sold tend to be the winners. That makes the market look healthier than it really is. So, what's a better way to think about all this? You need to stop trying to make art behave like a normal investment product. If you want art to have any chance of doing well financially, the more realistic approach is to build a collection, not buy into a fund. A collection has a plan, but it doesn't have a forced selling date. You can wait. You can hold the work when it makes sense. You can sell only when there's a real reason, the right buyer, the right moment, or because you want to free up money to buy something else. This also changes the feeling of it. A fund makes you anxious because it is built around selling. A collection is built around living with the work. That's not a soft point, it's practical. If the work never sells at the right price, you still own something worth having. There's another simple advantage. You can buy in depth. If you're buying work by emerging artists, you might buy more than one piece by the same artist. That gives you options later. You might sell one and keep one, or keep both. Either way, you aren't trapped. And finally, collectors don't just back artists. They help create the conditions for artists to succeed. Buying work funds, time, materials, and focus. It keeps a studio going. That can be good for the artist, and sometimes good for the future value of the work. A fund struggles with this because it's built to treat art as a trade, not a relationship. So the headline is straightforward. Art funds don't fail because art is worthless. They fail because funds are the wrong shape for art. The costs are heavy, selling is slow, timetables are artificial, and most of what matters in the art world doesn't fit neatly into a sales pitch. If you treat art like a normal investment, it can punish you in ways nobody warned you about. If you treat it like culture, with patience, judgment, and a plan, it might still reward you financially. Contact Blackbird Rook if you'd like to know more.